If you're saving for your first home, there's a government scheme that can quietly add thousands to your deposit. And most people walk right past it. It's called the First Home Super Saver Scheme. And today I'm going to walk you through exactly how it works and whether it suits you. Here's the headline number. Under the First Home Super Saver Scheme, you can withdraw up to $50,000 of your eligible voluntary super contributions, plus the earnings on top, according to ATO and government FHSS guidance for 2024-25. The catch is you can only count up to $15,000 per financial year towards it. Before any portal logins, you need to understand why this works. When you salary sacrifice into super, that money is taxed at just 15% inside the fund instead of your normal marginal income tax rate. For someone on $80,000, that marginal rate is around 34.5%, including Medicare. So the gap is enormous. Let's put real numbers on it. If you salary sacrifice $15,000 into super after the 15% contributions tax, you're left with $12,750 working for your deposit. If you'd taken that same money as salary and saved it 34.5%, income tax leaves you just $9,825. So the scheme gives you nearly $3,000 more every single year. Your first real action is to check whether you qualify and how much you can release. Log into MyGov, head to ATO Online Services, then Super, then First Home Super Saver, and request a determination. The ATO will show you your maximum releasable amount based on the eligible contributions you've already made. While you're in there, confirm you actually meet the criteria. You need to be 18 or older, you must never have owned property or land in Australia, and you can't have made a previous FHSS release because you only get one in your lifetime. You also have to intend to live in the home for at least 6 months. Within the first 12 months, it's practicable to move in. Now you set the machine running. Ask your payroll team to redirect a fixed before tax amount each pay, aiming to hit up to $15,000 a year of voluntary concessional contributions. Just watch your overall concessional cap, which is typically $30,000 a year and includes your employer's compulsory super, so don't accidentally tip over the limit. The final move is timing. When you're ready to buy, lodge an FHSS release request through MyGov and coordinate with your broker and solicitor so the money lands before settlement. After the funds are released, you generally have 12 months, with a possible extension, to sign a contract, and you must move in for at least 6 months within that first year. One detail that trips people up is how much actually comes back out. You can withdraw 85% of your before-tax concessional contributions, reflecting the 15% tax already paid, and a full 100% of your after-tax non-concessional contributions, according to ATO and Russell Investments guidance. On top of both, you get 100% of the deemed earnings. Here's a mistake I see constantly. People save their deposit in a regular bank account paying close to 1 or 2%. When inside super, those funds sit in your investment option earning more, and the ATO adds deemed earnings on release. Modelled over 3 years, the difference from returns alone is around $2,600 to $3,200 on top of the tax savings. The biggest myth is that super is locked away until retirement, so people assume they can't touch it for a deposit. That's wrong for FHSS because the scheme is specifically designed to let you withdraw eligible voluntary contributions plus earnings for your first home up to $50,000 total. The money is paid to you after the ATO applies the tax and offset ready for your deposit. When you stack the tax break and the better returns together, the gap gets serious. For someone on $80,000 saving $15,000 a year for 3 years, modelling on ATO tax bands and FHSS rules suggests they end up roughly $9,500 to $10,500 better off. Stretch that to 5 years and the difference can comfortably exceed $15,000. Let's recap the whole play. First, understand that super contributions are taxed at just 15%. Second, log in to MyGov and request your FHSS determination. Third, confirm you're eligible, set up salary sacrifice within the caps, and then time your release and contract carefully when you're ready to buy. If this made the First Home Super Saver scheme click for you, do future you a favour and start that MyGov determination this week, because every financial year you skip is $15,000 of cap you can't get back. Subscribe for more straight-talking first home buyer guides and check out our next video on the full first home buyer deposit roadmap.